In this week's video, we'll cover a recent stock market shift that has occurred only 2 other times in the last 28 years. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video with some generic pattern recognition concepts, and then we'll take these generic concepts and tie them to the present day. And by doing that, we should be able to learn something about longer-term bullish probabilities relative to longer-term bearish probabilities. Our task here, we want to see which portions of this graph look similar to the right side of the graph. So we want to look at this, and then we want to look backward and look for similar characteristics. If we look at the right side, one of the first things that we notice is blue is falling from high levels when blue is already above red. Blue is falling from high levels when blue is above red. Blue is falling from high levels when blue is above red. Blue is falling from high levels when blue is above red. In terms of this bullet point, we can see some similarities between this point here, and this point here. The other thing that jumps out to us from a pattern perspective or something that's fairly unique, there's a significant amount of white space between blue and red when blue starts to fall. There's a significant amount of white space between blue and red. There's a significant amount of white space between blue and red. And the third major characteristic from the right side of the chart is that red is starting to rise from low levels. Red is starting to rise from low levels, and red is starting to rise from low levels. With the key being red is rising from low levels in a situation where you can also check this bullet point and this bullet point. We have all of these characteristics at this point here, and this point here. And you can make an argument that these are almost mini versions. Blue is falling, there's white space, red is rising. Blue is falling, there's white space, red is rising. So there are some similarities to this point here and this point here to this point here as well. But it's pretty easy to see this is a good match and this is a good match. It's a little bit more gray area on the rest of this chart. So what have we been looking at, and how can it help us with the probability of good things happening relative to the probability of bad things happening looking out over the next several years? The source of the chart that we've been looking at is top-down charts and data stream. The blue line represents neutral sentiment, telling us that recently, this is 2016, 2017, neutral sentiment has started to fall rapidly. Neutral sentiment has started to fall rapidly. Neutral sentiment has started to fall rapidly. The red line is bullish sentiment. You can also see recently bullish sentiment has started to pick up significantly as neutral sentiment has fallen. So basically, people are leaving the neutral sentiment camp in here where they're not sure, and they're migrating to the bullish camp. People are leaving the neutral sentiment camp and migrating to the bullish camp, leaving the neutral sentiment camp over time and migrating eventually to the bullish camp. So when we were looking at this chart objectively, we said this point here was similar to this point here and this point here. This is the S&P 500 in black. You can see after this point, good things happened. After this point here, this is 1995. We've talked about similarities from numerous perspectives relative to 1995. After this, after we could see it, good things happened for a long period of time. How about from a bearish perspective? Does the present day look anything like a major turn in the stock market, from a sentiment perspective? In the present day, we have blue falling from a very high level. Bear market starts here in the S&P 500. We have red falling from a very high level. Bear market starts here in the S&P 500. We have red dropping like a stone. In the present day, it's been rising rapidly. And our other characteristic of the present day was just that, red rising from low levels. We don't have red rising from low levels here when bad things happen. And we don't have red rising. Red is falling from low levels here. So if we're using our bullet points as a guide, the present day really doesn't look anything like this period here or this period here. Nor does this period here look anything like this period or this period, and this period here doesn't look anything like this period or this period. If we add in some blue vertical lines, we can see the similarity, the similarity, the similarity. After that, good things happen in the S&P 500. Similar point, very good things happen in the S&P 500, which is shown in black. And remember, we said even these periods here had some similarities to the present day. What happened in these two instances? Was it bullish or bearish? The answer is in all four instances, good things happened for a long period of time after this point here when red started to rise. Good things happened for a long period of time after this point here when red started to rise. Good things happened for a long period of time when red started to rise, and good things happened for a long period of time when red started to rise. All four periods that look similar to the present day after a setup like this, good things happened for a long period of time. We want to make sure we give credit where credit is due. This fantastic chart that we've just reviewed was created by Callum Thomas. You can find his analysis by Googling this title here, or you can just go to See It Market, and you can find it there as well. Given the weight of the evidence should be considered in any rational decision-making process, let's go back and look at the weight of the evidence we've covered in recent months that tell us the present day is very, very similar to numerous setups that were in place in 1994 and 1995. On December 16th, 2016, our video looked at the question, does the present day look more like 1987, or does it look more like a 1994 like buying opportunity? The analysis that looked at monthly ADX basically reached the same conclusion that we reached looking at sentiment this week. And that conclusion is the present day, from a factual perspective, looks a lot like a favorable entry point period like 1994 or a favorable entry point period like 1982. And 2016, 2017 doesn't look anything, not even remotely close to 1987, nor does it look like 1998. And if you know the markets well, many stocks from a breadth perspective started to peak in 1998, and the major averages peaked later on in calendar year 2000. And you might remember from that video, the single best signal with ADX comes after black. Black falls below both red and green. Black has fallen below both red and green on December 15th, 2016. You also might remember we said when black rallies from below both red and green, it shows the market is waking up from a lull. And in that December 15th video, we said we really had a setup that black ADX had not yet started to rally, but every indication was that it would begin to rally. Has it? If we look at monthly ADX for the S&P 500, the answer is absolutely, positively yes, which means the present day now checks all of the boxes for the single best signal using monthly ADX. The December 2016 analysis focused primarily on the NYSE composite. And if you look closely here, the NYSE composite black ADX is now starting to turn up, and it previously was below both red and green. Another similarity between 1994 and 1995 and the present day is the long-term consolidation box. We've covered countless long-term consolidation boxes in the present day, including a 19-year consolidation box. Price was inside of this orange box for 19 years for the NYSE Composite Monthly. We said we had a long-term consolidation box in 1994 and 1995. We also had a very long-term consolidation box for the S&P 500 in 2014, 15, and into calendar year 2016. If we look at one of these consolidation boxes as of June 8th, 2017, the longer we go sideways, in this case, price was inside of this box for 7,093 calendar days, which equates to 19.4 years. The longer we go sideways, the bigger the move we can expect to get. We've also shown on numerous occasions that there was a similar look looking at the S&P 500's simple 100-day moving average here. Here's 1994, 1995, consolidation, bullish breakout. After that, good things happened for a really long period of time. On December 2nd, 2016, we covered a relatively rare long-term momentum shift in the S&P 500. It's occurred 1, 2, 3, 4, 5 other times since 1993, and as you might have guessed, one of those times was calendar year 1995. You can find the December 2nd, 2016 video by Googling this title here. On March 1st, 2017, we published a monthly Bollinger Bandwidth analysis. Bollinger Bandwidth helps us with the sleepiness factor in the market. When the width gets very, very low, you have a sleepy and trendless market, and often big moves follow sleepy and trendless markets. Big moves follow sleepy and trendless markets. Big moves follow sleepy and trendless markets. In that analysis, we showed that it's very, very rare for the monthly Bollinger Bandwidth to get this low. 2 other times it happened, you might guess, 1995 and 1982. Both excellent long-term entry points. You can find that analysis that was published on See It Market by Googling this title here. On March 3rd, 2017 video, it included an analysis using monthly RSI for the S&P 500. And as you might have guessed, 2017 looks very, very similar to 2 calendar years. One of them is 1995 and the other one is 1982. This chart is dated June 8th, 2017, telling us that everything that we included in the original analysis still applies to the present day market. You can find the original video by Googling this title here. If we look at present day valuations in isolation, it would be easy to draw the conclusion that they're very, very concerning. But if we take a bigger step back and look at valuations, it really becomes obvious to draw the conclusion that PE ratios and valuations are really not helpful at all in terms of timing entries and exits from the stock market. What about the complacency in the present day? The VIX in 2017 has been extremely low. Well, as you might have guessed, the VIX was also extremely low and at very, very similar levels to the present day in calendar year 1995. When the VIX was hovering around levels that it's hovering around in 2017, the S&P 500 posted a 34% gain from point A to point B. Another analysis that pointed to similarities between the present day in 1994 and 1995 was published in January of 2017. Also uses somewhat of a sleepy indicator in the Kopic curve here. If we look at the monthly Kopic curve from a longer term perspective, you can see here's one of those rare moves. It comes down and holds near the center line. After that, in 1995, good things happen. It comes down and holds near the center line in calendar year 2013, After that, good things happen. And in calendar year 2016, we had a very, very similar look. Often, out of sleepy and trendless markets, big gains appear on the other side. And as we've demonstrated in many writings and videos, in recent months, the present day, using the Koppel curve, also doesn't look anything like a bull market peak. Rather than holding near the center line, the monthly Koppel curve clearly broke through the center line. After that, after we could see it, measure it, put it in a model, really bad things happened in the S&P 500. This is a monthly chart. After it was unable to hold at the center line, really bad things happened in the S&P 500. You can find the Koppel curve analysis in its entirety by Googling this title here. And in last week's video, we provided numerous examples of facts in hand, hard data charts that we could look at and measure that say the present day looks more like a stock market bottom, present day meaning 2016, 2017, and really doesn't look anything like a major stock market top. The facts in hand on August 19th, 2016 helped us draw similar conclusions in that video titled "Signal Has Only Occurred 10 Times in the Past 35 Years." 1995 was one of those 10 times. After it occurred, the stock market rallied for 235 weeks. How many weeks have we been rallying since August of 2016? The answer is 40 weeks, which means if the duration of the present day rally was similar to the duration of the 1995 rally, we have completed 17% of this move. And from a duration perspective in weeks, 83% of the move would still be in front of us. And as we'll cover momentarily, you can make sound arguments that the setup in the present day is quite a bit better than the setup here, which tells us it's possible, within the realm of possibility, no forecasting here, taking it day by day, within the realm of possibility that this rally lasts longer than 235 weeks. And many of you remember that we used the 30, 40, and 50 for illustrative purposes only, weekly moving averages in that analysis. And if we wanted to see one more example of pattern recognition that looks very, very similar to the present day, here are those same moving averages in 1995, and here are the identical moving averages in calendar year 2016. How can we make a rational case that this rally might last longer than this rally? If we compare similar points in time for the 1995 rally and the present day rally, if we look backwards 3,500 calendar days in 1995, the NYSE Composite had already posted a 154% gain. This is a lot of fuel that's been expended to get from point A to point B. Contrast that with the tepid 13% gain that we get when we look back the same 3,500 calendar days from a similar period in 2017. There's a lot more fuel and pent-up demand on this chart relative to this chart, telling us this move here could be bigger than this move here. Similar concepts if we look back over 6,000 calendar days. 457% gain in 1995, 61% gain in the present day. A lot of fuel has been used. A lot of fuel potentially remains. And where could that fuel possibly come from? Remember, we said the Gallup organization conducted a poll in 2016, and the results told us that a record low number, based on the poll's history, of American households said they had exposure to equities. If the 52% number starts to creep back to the 65% number, that means a lot of households would be moving cash off the sidelines and into the stock market. Here's another example of hard data or facts that support the concept that it's within the realm of possibility that the rally in the present day could last a lot longer than this rally here. That's not a forecast. We're just saying it's in the realm of possibility and we should keep an open mind about it. The longer a market goes sideways, the bigger the move we can expect to get when we either get a bullish breakout or bearish breakdown. The market was moving sideways for 640 calendar days when the bullish breakout occurred in 1995. The longer a market goes sideways, this is a little bit longer. In the present day, the exact same index had been moving sideways for not 640 calendar days, but 1,434 calendar days when the bullish breakout occurred. This tells us the present day spring is coiled a lot tighter than the spring was in calendar year 1995. This chart and all of the charts that we've reviewed help us with nothing more than probabilities. The probability of good things happening relative to the probability of bad things happening. The probability of bad things happening is never zero. Remember last week we talked about a very long-term breakout in semiconductors, or SMH. It should be noted, if you're a client, if you look at our exposure, which is incredibly small on a percentage basis to semiconductors, that was done for a reason. We have almost a vertical move here, and in the short term, that equates to uncertainty and potential risk. If we look at NVIDIA Corp, ticker symbol NVDA, on Friday, June 9th, you can see intraday we had somewhat of an ugly-looking intraday reversal, and prior to that, we have almost a vertical move here, which is why our exposure to semiconductors is so low at the moment. We'd like to try to find a little bit better entry point to add to that position. In the short run, the negative thing is this is an ugly looking candle intraday. From a positive perspective, though, what once was resistance may now act as support. Not only are semiconductors extended potentially in the short run, but they're fairly volatile as well. So no matter how advantageous the entry point, our exposure to semiconductors specifically would be somewhat limited over time. After some indecisiveness and intraday volatility on Friday, June 9th, let's take a look at the long-term outlook. Our original hypothesis was that a long-term trend might be starting here near the U.S. election, and on June 9th, there's nothing on this chart with our 30, 40, and 50-week, for illustrative purposes, only weekly moving averages that says anything has changed. When price gets extended from the moving averages, it's possible that we may come back at some point and revisit these moving averages. In fact, it's not possible, it's a certainty. Some point in the future, price will come back and touch some of these moving averages. But it can do that within the context of an ongoing uptrend. From a long-term perspective, looking out weeks, months, and years, the present day really doesn't look anything like the high-risk look that we'd like to avoid that we could see here in calendar year 2000 before really bad things happened in the S&P 500. June 9th, 2017 doesn't look anything like the 2007-2008 peaking process in the S&P 500. If this chart starts to morph into something like this, then our outlook and attitudes towards any pullbacks might change. In the short run, a pullback from a mathematical perspective would most likely be classified as volatility to ignore within the context of an ongoing uptrend. How do the same 30, 40, and 50-week moving averages look in some sectors and some other ETFs? The total market here, you can see we are extended from the moving averages, and we may need to come back and kiss these moving averages and revisit them at some point. The tech sector's had a very, very nice run, and if you look at our accounts in general too, we're not wildly overweighted in tech. When we added to our tech in recent weeks, we knew that we had this white space in here, and our allocations relative to our entire account reflects that. Our exposure to technology is a long-term exposure to technology, looking out months and years. Similar situation with growth stocks. We still have a full-bore bullish look. We do have some white space in here. Industrials, XLI, prices above all three moving averages. Blue, the fastest moving averages on top, and the slopes of all the moving averages are positive. Home construction broke out of a nice long-term consolidation box here, and as it broke out of the box, it got a bullish cross here and now has a full-bore bullish look. Like many of the charts here, we have some white space, which means we're extended a little bit, and we might have some normal and 100% to be expected pullbacks. Similar situation, this is a broad advance. It's very, very difficult to say it's not a broad advance when the equal weight S&P 500 ETF keeps making higher highs and has a full-bore bullish look. All of these charts help us with the long-term outlook. They don't say much about what's going to happen early next week or over the next few hours. History tells us when we come out of one of these long-term consolidation periods and we move into a look that looks like a new long-term and sustainable trend, that even after a successful bullish breakout, nothing is ever going to be easy in the markets, because no matter how strong the trends are, we always have volatility within the context of an ongoing uptrend. We always have normal and 100% to be expected volatility within the context of an ongoing uptrend. It's very, very important to keep our eye on the prize. Our objective is to move from point A to point B here. In this case, the long-term trend after the bullish breakout lasted 3.5 years, and if you were able to withstand the volatility to ignore and remain disciplined, the reward in this case was a gain of over 148% between point A and point B. There were a lot of opportunities to get shaken out by what turned out to be volatility to ignore. With Friday's volatility, it makes sense to focus on some longer-term trends. This is the 200-day moving average of emerging markets, EEM, relative to IWF. Growth stocks, we have somewhat of an indecisive and rollover look here. For emerging markets, we prefer to see some stability in the look of this 200-day. June 2017, growth stocks relative to the S&P 500. Growth-oriented financials relative to defensive-oriented consumer staples. This is the long-term trend. Slope of the 200-day moving average and the long-term trend in risk-on, risk-off stocks, SPY relative to TLT, is not throwing up any red flags from a long-term perspective. If large institutional managers were starting to get seriously concerned about the longer-term outlook, we would expect to see capital flows into XLP. Well, right now, XLP, from a trend perspective, this is the 200-day, is clearly remaining a laggard relative to the general market. Similar situation here, the total stock market, June 2017, relative to defensive-oriented gold. To summarize some of the similarities we covered between 1995 and 2017, in recent months, both periods featured consolidation and sleepy trends, somewhat questionable valuations, indecisiveness and low conviction from an asset class performance perspective, head fakes and whipsaws, bearish turns, bullish turns. Eventually, from the consolidation, we saw bullish breakouts. Long-term momentum shifted in a clear bullish manner, and as we described in this week's video, both periods featured a very rare sentiment shift, telling us to keep an open mind about better than expected outcomes over the next few years. An open mind, or being open to, is not a forecast. If the data that we have in hand remains favorable, then we will continue to err on the side of remaining fully invested with a long-term stance. But remaining flexible and open-minded to all outcomes at all times will allow us to see when volatility to ignore eventually morphs into volatility to respect, requiring some defensive chess moves. Keeping in mind that our goal is to navigate from point A to point B, and we'd really like to do so when we have strong trends like this and trade as infrequently as possible between point A and point B. The recent moves that we made in our portfolio, we did not make them because we believed that the market was about to reverse or the trends were about to end. We made them because the positions that we hold today give us a much higher probability of navigating from point A to point B, and doing so with the least amount of movement in our portfolio over the coming months and years. We're very, very happy with the portfolio that we have right at the moment. The facts that we have in hand right now say that any pullback would most likely be classified as volatility to ignore. And as long as the trends and facts tell us that good things are most likely going to happen from an odds perspective relative to bad things, our focus will remain on the longer term outlook. This is 3.5 years here after a bullish breakout. If we look at this chart here, it's pretty easy to see the path of least resistance is up. Given what we know on June 9th, every single one of these charts, the path of least resistance remains up. The same can be said for the long-term outlook for the S&P 500. We'll conclude this week's video with some trading principles from Jesse Livermore that can help us maintain that long-term outlook and improve our probability of navigating from point A to point B, and doing so with the least amount of trading possible. A few points about Friday's volatility. Number one, this is 2:45 p.m. on Friday, June 9th. The S&P 500 is down 0.4%. And market fractals tell us that trying to navigate from point A to point B here is the same as trying to navigate from point A to point B over a 4 or 5 year period. And as we would expect, there has been plenty of volatility to ignore between point A and point B. And one thing we can guarantee with 100% certainty, if the charts are correct and the markets exceed on the upside in the next 3 to 5 years, then there will be a ton of volatility between point A and a point B that's off the chart. It's a daily chart of KRE, one of the regional bank ETFs. This is our A to B move here. You can see we move back inside of the Fibonacci retracement box here, trying to make a stand at logical levels, also near an upward sloping and still bullish 200-day moving average. We also had a try to be patient divergence here. This is a bullish divergence with daily RSI. Technology had a rough day on Friday, but our focus is much, much longer term. Why? Here's that long-term consolidation box. This is the look of the monthly chart after that rough day on Friday. This is as of the close on June 9th, 2017. We still have that bullish breakout. You can see here consolidation. Good things happen for a very long period of time with lots of givebacks and consolidation along the way. Look at the slope of the 50-month moving average as we break out of the box. How significant could a 20-year consolidation period be relative to the future or the coming years? Or if we wanted to phrase the question in another way, you could say, Chris, come on, you're killing us with all these boxes. Why are you covering so many boxes? Well, here's a box that we covered in one of our videos back in calendar year 2013. And you know, the longer a market goes sideways, the bigger the move that we can expect to get. And this is a high probability look here when you're able to clear the box and hold above the box. What happened next in this case? The answer is very, very good things for those that were patient and kept a focus on the longer term significance of this breakout from the box. Harder markets are typically followed by easier markets. Harder markets are typically followed by easier markets. Harder markets are typically followed by easier markets. The longer a market goes sideways, the bigger the move that we can expect to get. The longer the NASDAQ stays above the box, the more meaningful it becomes. As of the close on June 9th, it's still above the box. Might be helpful to see a visual. Another question you might want to ask is, why do we reduce our exposure to small caps and mid caps? We covered it a few weeks ago. You can see this is a long-term chart of small caps relative to the S&P 500. This is a 50-month moving average, and you can see when we entered the market, it looked like We had a breakout above the 50-month moving average, and this was trying to turn up in a bullish manner. And then as we covered a few weeks ago, now this looks like a failed breakout. So we're open, we're always flexible, we're open to looking at small caps or adding to our position in small caps if we'd like to see price clear the top of this downward sloping channel. Right now, until something good can happen like this turning up or price moving here, this looks like a counter trend rally within the context of an ongoing downtrend that favors the S&P 500 over small caps. Maximum flexibility tells us we're not using this to forecast, but this is what's in front of us today, and this is a concerning failed breakout look until the chart can clear it. Very, very similar situation with materials. They've done some good things here. There's some good things to see here, but we really need to see more materials relative to the S&P 500. Very, very similar situation with mid caps for the most part. This looks like a long-term downtrend that favors SPY. This looked like a bullish breakout, 50-month turning up, but now it looks more like a failed breakout. Again, not forecasting. Maximum flexibility tells us we're open to looking at mid caps and adding to the mid cap, small cap position again, but we need to see some proof. We had some proof, but it failed, and failed breakouts can be scary. And here's a long-term chart that's more constructive. Technology relative to the S&P 500 or SPY, 50-month moving average, long-term consolidation box here, bullish breakout, what appears to be a successful retest, and then a higher high. From a long-term perspective, XLK looks good relative to SPY. Could it underperform for several weeks or several months after this move here? Absolutely, positively, yes. Our focus is long-term here. Technology could beat the S&P 500 if this breakout holds for several years. We said we reduced exposure to small caps and mid caps, didn't eliminate it, reduced it. We reduced our exposure to banks, but not nearly as much. We kept a bigger stake in banks. Why? This really doesn't look like a failed breakout. This is a downward sloping trend channel, a bullish breakout. The 50-month is turning up. Now this looks like potentially a successful retest of the breakout. The jury is still out on banks long term, but there were more reasons to be patient and thus holding the larger stake. If we look more broadly just at XLF, the KRE and KBE are regional bank ETFs. We've got a long-term break above this downward sloping trend line relative to SPY, and this is a higher low here relative to this low here. When we had the breakout, we also had the 50-month trying to turn back up, and this also looks like it's trying to have a successful retest. We'll keep an open mind about all outcomes, but this chart here gives us more hope, given what we have in front of us, than small caps and mid caps. Doesn't mean bad things are going to happen with small caps and mid caps. We would just like to see more from a relative performance perspective. If we look at this chart here, it's pretty easy to see the path of least resistance is up. Given what we know on June 9th, every single one of these charts, the path of least resistance remains up. The same can be said for the long-term outlook for the S&P 500. We'll conclude this week's video with some trading principles from Jesse Livermore that can help us maintain that long-term outlook and improve our probability of navigating from point A to point B and doing so with the least amount of trading possible. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.